Okay, so it has started. Now, what I was saying, we have done dividend theories, we have done dividend policies. This we had already discussed in the previous classes. And if we again start with this, so just a recall to what we have done. So it is related to dividend theories. We have seen that under this dividend theory, there are two theories that we are going to study or we have studied. It is related to relevance theory and theory of non-relevance. When we talk about relevance theory or irrelevance theory, relevance or irrelevance is related to the payment of dividend that we make. It is said that when we pay dividend, when we declare dividend and the payment is made, how it is going to affect the value of the company. Is it going to make any change in the market value of the company, in the market value of the shares, or it is simply just the payment of dividend? So in relevance theory, it says that yes, it is going to change your earning per share, and with a change in the earning per share, your value of the company is also going to change. At the same time, irrelevance theory says that whatever dividend we distribute, it is only a part of your profit distribution. It is nothing to do with the value of the firm, because the value of the firm is not only affected by dividend, but there are several other factors through which dividend is affected. So in such case, what we say, we compare the relevance theory. The relevance theory is given by Walter and Gordon, and then we come to the irrelevance theory, which is given by hypothesis, that is Miller hypothesis. So when we talk about this, you need to understand why dividend, how it is paid, the types of dividend, the ways dividend can be paid, whether in cash and stock, and like this we find out how the payment is made. So other than the theory part, we don't have to go with the calculations because it is higher financial management. You only go with the theoretical part. You take its hypothesis, objectives, and its implication in the share market. So when we talk about the first part, that is the relevance theory, in relevance theory what happens? It says that the impact of dividend decision on the value of a firm and its cost of capital. The traditional view, it is not supported by any empirical evidence. They suggest that liberal dividend policy always enhances the value of the firm. Now, when we talk about liberal dividend policy, liberal dividend means the payment of dividend made in a very manner. More payment of dividend is made. Then we talk about the Walters and Gordon's model under this relevance theory. And in this relevance theory, we have seen there are three groups: normal, growth, and declining stage. Normal is when your returns are equal to your cost. Declining when your returns are less and cost is more. And growth is when your returns are more and cost is less. So in such cases, we decide how much dividend has to be paid and how much dividend has to be retained. Okay, so this one is clear, relevance theory. Just let me know. This we have done before also. When we talk about this relevance theory, see what happens. We are talking about here three groups, that is normal, growth and declining. So when we talk about dividend, we are distributing dividend in terms of your profits. So when you distribute the profit, there are two ways. Either you keep your profit with you or you distribute, or else you can have both. Keep a certain part of your profit as retained earnings and then distribute the remaining one as dividend. So the case when the firm is in the growth stage, your returns are more compared to your cost of capital. This is a growth stage. And in growth stage, if you put more capital in the business, it will give you more returns. So this is the period where you go for declaration of less dividend and try to use the retained earnings in the firm. When it is a declining stage is a stage where your returns are very less compared to your cost. So in this case, even if you put additional amount of money, you induce additional money capital, then also the returns are not going to change. So this is a stage where you will not like to put more money in the retained form. Else what you are going to do, you are going to hold the amount and put it to dividend. At least the people are going to get more amount in case when the firm is not in a growth stage, it is in the declining stage. So here the dividend payout ratio is more, and at times it may be 100%. In growth stage, the retained earnings is more, and at times it may be 100%. When we talk about normal is a stage where if you apply more, you may get returns more, or there is also a chance that you may not get returns more. So in such a situation, it is the decision of the board, the management, to decide whether they are going to go for more retained earnings or they are going to pay it in the form of dividend. So these are the three basic the situations which arise in your relevance theory, and then finally we come to the M&M model to find how this dividend decision is independent and it is irrelevant in deciding the value of the firm. So this is the first part. So I hope this is clear to you all. Or else if you have any doubt, you can ask. Do you have any doubt? This already we had discussed in the previous class also. Come on, tell me.
Yeah, ma'am.
Have you all gone through it after the
No, ma'am.
classes?
All good. Thanks.
After the last class, a month before, have you gone 20 days back? Just have you gone through the content? Or it's again you are seeing the content? I do understand we don't have that much time to go through it. But anyways, I think your exams are nearby. That's why ma'am has asked me to take this class. Just tell me, Chipulumutsu,
Yes, ma'am.
have you gone through it?
Yeah, I'm here.
Okay. So now I am coming to the next part. It is your dividend policies. How you decide the dividend policies. So when we talk about dividend policies, the first one is forms of dividend. Forms of dividend means you are going to pay the dividend in which the first one, as you can see, It is your stock dividend. In stock dividend happens that you do not pay dividend in form of cash, but at the same time you issue the equity shares of your is payment of dividend. I hope you understood. You need to pay or you need to hold cash for further business activities. So what you do, you do not pay the dividend in cash, but what you do in order to issue equity to the value of dividend. Pay shares against the payment of dividends, and they're periodically issued by the companies in the form of usual dividends. There are certain guidelines which are issued against the payment. The shares which are issued against the payment of dividends as bonus shares. So again I repeat, when we pay shares against the dividend, the shares are known as bonus shares. The motive of issuing shares against the payment of dividend is that we may be requiring cash for for having programs in expansion, diversification, or else we may not have enough cash with us for the dividend. Shares is the recapitalization of the owner's equity portion, and it is just a transfer of reserves to put in the capital for issue of shares. The shareholders get dividends then will be on the basis of the number of shares they own originally plus the shares which has been issued against the owner's shares. Total representation in the sum will be of originally owned shares, and second, the shares which they have been issued against the payment of dividend. Yes, Hosseini, you want to ask something? Yes, Hosseini, just let me know you have raised your hands. Do you want to ask something?
Yes, ma'am.
Yes.
Your network is fluctuating. We can't hear it.
You're not able to listen to me. Is it this with everyone or it's only with you? Others also, please respond.
Yeah, it is the same with me. I cannot clearly get you.
You are
Grace,
breaking,
can you
ma'am.
listen to me? Grace, can you listen to me?
I think you are having network issue.
Okay. I'm just switching to some other network. Just give me a minute. Is it clear now? My voice is clear?
Yes, ma'am.
Now you can listen to me.
Yes, ma'am.
Okay. Thank you, Sunny.
You're welcome.
So again, I will just repeat the last 2 3 lines what I spoke about. I was talking here about the payment of bonus, or sorry, the payment of dividend. Once dividend is declared, it has to be paid. So at times we may think that we are not in a position to pay dividend in cash. The reason may be either there is a shortage of cash, or the second reason may be that we want to hold the cash for retained earnings. There may be some future expansion or diversification plans, and for this reason we need to hold the cash. So when we need to hold the cash, of course, we will not be paying it to the owners or shareholders in the form of dividend. But as dividend has to be paid, so what we do, we issue equity shares against the payment of dividend. And these equity shares which are issued against the payment of dividend, they are known as bonus shares. Now, in the next time when we require to pay dividend, the total capitalization or holdings of the shareholder will be originally owned equity shares plus the shares which has been issued against dividend. So in total, they all belong to equity share family and dividend will be paid on both the shares. Am I clear? So this is known as stock dividend. When we issue shares, shares are known as stocks. So when equity shares are issued against the payment of dividend, the shares are known as bonus shares, and this is one of the form of paying dividend. Am I clear?
Yes, you are.
Next, it is stock split. Now, what is stock split? Stock split is a method of either increasing or decreasing the number of shares outstanding and thereby proportionately lowering the raising the market price per share. Now, if a company believes that its share is priced too high and that lowering the market price will enhance the trading activity, so what they do, they divide the one equity share into two or more shares. Now, here's an example given to you. For example, before the stock is split, you had 2 lakh shares of rupees 10 face value. So, your amount is 2 lakh rupees. After stock split, what happens? Instead of 10 par value, you are splitting it into rupees 5 par value. You have divided the par value, though the amount remains the same, but the number of stocks, the number of shares is going to be increased. I hope you are understanding what I am saying. Yes? You understood what I am saying? If you have 100 shares of rupees 10 each, then 100 into 10, it is 1 lakh. 1,000 shares of rupees 10 each, then 1,000 into 10, it is rupees 10,000. Now you want to increase the number of shares. So what you will do, instead of rupees 10, the face value of the shares will be rupees 5. So same happens for 5, 10,000, and then the amount is same. You have split it. The par value is split. You are not disturbing the amount. So instead of that, you are increasing the number of shares. Understood? 5 is half of 10. So what you are going to do? You are multiplying it with the number of shares. So this is what we talk about, splitting of shares. The third, it is stock repurchase. Stock repurchase is buyback of shares. Buyback of share means the shares which are in the market given to the shareholders, we take back from them. Understood? So stock repurchase is that the company repurchases the issued share to change their capital structure. So companies with exceptionally good financial position, liquidity position, they do not need to attract the investment from others. They go for buyback of the shares. A company can buy back its stock from the existing shareholders on a proportionate basis through the tender offer in the open market. And this is done either through book building process or through stock exchange and from odd lot holders. Next, it is property dividend. You assign any of your asset property against the payment of against the payment of dividend. So, if a company may issue a non-monetary dividend to investors rather than making a cash payment or a stock payment, this form of dividend is unusual, and such dividend may be in the form of inventory or securities in lieu of cash payment. The next form is debenture dividend. Instead of paying cash or stock, we issue debentures against the payment of dividend to the shareholders. So the debentures, they bear interest, and the interest is also payable after a prescribed period to the existing shareholders. So it is just creating a long-term debt, and this issue of debentures against the payment of dividend is not a very common practice. Next, we have scrip dividend. A company may not have sufficient funds to issue dividends in the future. So, in such a situation, it issues scrip dividend. So, what is scrip dividend? The dividends can be paid only out of profits earned in that particular year or in the past when it is reflected in the form of accumulated profits or reserves. So the profit do not necessarily mean adequate cash to enable payment of cash dividends. So we may also issue convertible dividend warrants which may be redeemable after few years. Next, it is liquidating dividend. Liquidating dividend means that when the board of directors wish to return the capital which they have originally contributed as a dividend, it is called liquidating dividend. So, liquidating dividend is like the entries for a cash dividend, except that the funds are considered to come from the additional paid up capital amount. Now, if we go with the factors that affect the dividend decision, it is ownership consideration, whether the owners of the company, they want to declare dividend, and even if they want to declare dividend, what will be the form in which they are going to pay the dividend. We have certain firm oriented consideration other than the owner's consideration, certain considerations which are beneficial for the industry or for the firm. So first consideration is related to contractual and legal restriction. Contractual and legal restriction related to the issue of dividend. Then we try to find out the liquidity, credit standing and working capital needs of the firm. Are we in a position to pay the dividend in cash? Do we have that much cash? And even if we have, what are the future requirements of that cash? We need to also consider the dividend decision whether to be paid or not to be paid, and if in case it is paid, what will be the dividend payout ratio. Next consideration is need of funds for immediate future expansion. If you require more funds for immediate use, that is for future expansion, in such case you will not go with the declaration of dividend, because the funds which are not the cash, the profits which are not declared as dividend and paid, they can be used as retained earnings. We also have availability of external capital. Sometimes we do not have the scope of raising funds from external sources from the market. So in such case, we rely on the capital that the firm has within itself. And it is only and only retained earnings, which is the internal source of financing. Then risk of losing control of organization. If you issue more and more equity share capital, we invite more and more people to be the owners of the company. In this way, the control is lost. More and more people, when they join, they become owners. The control, which is limited to few people, is lost. We have a relative cost of external funds. Relative cost of external fund means that when you raise funds through other sources, what is its cost when it is compared to your cost of retained earnings? If the relative cost is high, we will 100% rely on your internal financing. Business cycles, recession, inflation, boom period, this all also affect the dividend payment decision. And the last, it is post-dividend policies and stockholder relationships. Once dividend is paid, what does stockholders think about the company? If the dividend is paid on a liberal rate, the people are very happy and expect more in the near future. But if the dividend declaration rate, the dividend payout rate is not good, in such cases, the stockholder has to compromise with the existing dividend. Now the next is determinants of dividend policy. What are the dividends? The factors determining the dividend policy? It is the external factors. Under these external factors, it is the state of the economy, which differ from economy to economy. We have the state of capital market, the investment in the capital market, the implication of tax policy on dividend holders, inflation, and requirement of institutional investors. If we start with the internal factors, it is the nature of the business. Second, we are talking here about the composition of the shareholders in the organization. Then alternative uses of funds kept from the from the earnings of profit. Then control, desire for liquid funds. At times, people may want more liquid funds than to be distributed in the form of dividend and other factors. In other factors, we take the cases like how it is going to affect the money supply, what will be the capital expenditure, how much amount you require to promote yourself. So these are the factors affecting or the determinants of dividend policy. There are certain dividend paying policies like stable policy when you pay dividend on regular intervals, regular dividend, every year you declare dividend, irregular dividend, at times you pay the dividend, at times you do not pay the dividend. So these are sometimes regular plus extra, sometimes it is only stable, whatever is your profit, even if it is abnormal profit, you pay only the regular dividend. If you go with the summary of this chapter of dividend policies, then it talks about that dividend is a portion of the profits which is distributed to the shareholders in a company, and it is usually expressed as a percentage of the value of shares. If it is 6% dividend declared, then 6% of your holdings, your value of shares. Dividends are often paid in cash, though in theory, the other firms or other forms of payment of dividend also exist. The dividend policy involves the decisions whether to go with retained earnings in the firm for capital investment and other purposes, or to pay out the earnings in the form of cash dividend to shareholders. There are many financial managers who believe that a stable dividend policy with a certain percentage on paid up capital and with periodic increases is a better course to follow. So we should always go with stable dividend. It should not be like in 1 year we have decided to pay dividend at huge rate and for the next 3 years we are not paying that dividend. No. What is suggested that even if it is low rate, okay, but every year there should be a continuous payment of dividend. Besides being psychologically appealing, stable dividend also has an information content in that it indicates the investors, the management's expectation on level of long-term earnings and growth. So often the company has to strike a balance between its own needs for funds for financing growth opportunities and the needs and expectations of the investors. So in view of this, therefore, dividend policy cannot or should not be regarded as a residual policy. Residual matlab, once you pay all the profits, then the balance is to be paid as dividend. No, it should not be treated as a residual policy. While it is true that companies with strong investment opportunities have relatively low dividend payout ratio and then vice versa. Most of the financial managers like to follow a stable dividend policy. There are several factors which impinge upon the dividend decision. They are known as the determinants of dividend policies. The attitude and objectives of management, nature of business, composition of shareholdings, cash position, and future needs for funds are some of the important considerations which have a bearing on the dividend decision. So this is all about your dividend decision and dividend theories. You just let me know the explanation is clear or not.
Very clear, ma'am.
Is it clear?
Yes, ma'am, clear.
Very clear. Yes, it is.
Okay.
Yes, ma'am.
Now you let me, we are done with the block 4. It was just the summary. Now you tell me what to do. If you have any doubt, any query from your side, the forum is open, you may ask. Just let me know. I will just show you one video related to dividend models, all this Walter and all.
दो थियरीज दी गई, एक इररिलेवेंट थ्योरी, दूसरी रिलेवेंट थ्योरीज। कम डिविडेंड आया है कैश में तो अपने
हेलो दोस्तों, स्वागत है आप सबका मेरे यूट्यूब चैनल सचिन एजुकेशन हब पर। दोस्तों आज हम बात
This is the formula. As always I do, I would request you to write the formula. I am not going to explain anything. We will first deal with calculations and then I'll show you the real implication of this formula. And if you are interested, I will show you the logical derivation of this formula. And when you write a formula, of course what you need to do is you need to write the formula along with all the variables that are being used in the formula. So write all the variables. Even though this formula appears in your book, that doesn't mean that you should not write everything systematically. The logic behind.
Are you able to listen to the sound?
Yes, ma'am, we can hear.
Okay, just listen to it. Though formula is not very relevant, but how it is correlated, that you can see.
Behind this MM's model and the derivation of this formula, logically as well as mathematically, both way, I will definitely show it to you. But let us do one thing. Let us first take a calculative example. First we will learn how to apply this formula by substituting the meaning of all these variables, and then we will logically understand the whole base behind this formula. Right now let us take up question number 12. Let us read this question. It says number of shares at the beginning of the year as 1 lakh shares. Additional shares issued by end of the year, it is 12,000 shares. Expected share price by end of the year is rupees 500. Total earnings expected is rupees 1 crore. Investment obligation by end of the year is rupees 1 crore 60 lakhs. equity capitalization rate is 25%. Determine the current value of equity share using MM's model. So because I haven't explained you anything, I cannot expect your involvement at this stage. So in your solution, you should obviously first write the formula and then define all the variables. Now you might be wondering that, sir, just a couple of minutes back you made us write this whole thing, then is it really needed that we should write it again? And you know what is going to be my answer. You must write it, you must write it, you must write it. So this is going to be part of the solution and therefore it cannot be avoided. Next task what you would do is, you would just substitute the value of all these in the formula. Your objective is to find the value of P0. Make the calculations. I don't have to actually explain you how to calculate. It is simple: plus, minus, multiply and divide. So we get to know that 1 lakh into P0 is 4 crores. So P0 value will be 4 crores divided by 1 lakh and P0 will be 400. So P0 being 400 is your final answer. You have not been explained anything by me yet. What we have seen is a type of question that can be asked in examination for around 4 marks, where you just have to put the values, apply the formula, get the answer. And that is what you have done over here. Being a little mechanical is not going to help you, correct? So you are definitely interested in knowing the logic behind all these calculations. I would request you to just keep a little more patience, just a little more patience. And when we are moving ahead, we will be dealing with another question, that is question number 13. And this is the question where I promise you I'll explain everything required in MM's model. So let us read question number 13. P0 is given as rupees 200, KE is given as 25%, number of shares at the beginning of the year is 20,000. The company has an investment plan at year end amounting to 20 lakhs. Determine the expected price of the share at year end. If the expected dividend is, they have given case 1 and case 2, and case 1 says dividend payout is 0 and case 2 says dividend payout is 100% and rupees 50 is the expected dividend in second case. Further, the question is informing you, in order to finance the new project, show the number of equity shares to be issued under each of the above cases. And last line in the question says, use MM's model to prove that the present value of equity shares remains same irrespective of dividend. Alright friends, so we have just read the question, and over here I would ask you to maintain a bit of patience, because through this example I am going to explain you the logic behind MM's model along with the derivation of its formula. Now please keep a lot of patience, write only and only when I am instructing you to write. Otherwise, when I am explaining concepts, please carefully understand. So friends, what we will do is, we will not do a single line calculation without logic now. Just ignore MM model formula, completely ignore that formula. I will show you one thing, that we can make all the required calculation without using that formula. We can do everything logically. Let us see how to do that, and no writing business, everyone's attention over here. I am bringing forward a formula that we have understood logically long back when we started this chapter. In fact, before we started this chapter, we have learned this formula along with the meaning of each of these variables. What is D1, what is P1, what is KE, what is P0, and When we cross multiply, what we will get, do you know? P0 into 1 plus KE equals to D1 plus P1, and therefore P1 equals to P0 into 1 plus KE minus D1. Now what I can assure you, whatever is appearing on screen, I can assure you there is nothing that you do not follow. This is something that we have already learned, and the couple of equations that you are finding on top right side are the equations derived from this core formula of P0. I am sure you can agree with me that no explanation is needed on this from my end. Let me take you ahead, and what I will do is I will get started with case 1. Here I am writing that same equation what I wrote in the previous slide. P1 equals to P0 into 1 plus KE minus D1, and in case 1 now I will substitute these values and determine the value of P1. So P1 value for case 1 would be 250, and in case 2 the P1 value will be little different, of course, because over there the dividend payout is not 0, it is 100%, where dividend per share is rupees 50. So P1 will be 250 minus 50, so P1 will be 200. And one thing that you should identify in case 1, because D1 with 100% dividend payout is rupees 50, understand it very clearly that if dividend per share is rupees 50 and dividend payout ratio is 100%, it is obvious that earnings per share would be rupees 50. So nothing that appearing on screen will be difficult to understand. If you have understood the previous slide, you will definitely understand this one as well. Now please keep up your patience level, and let me explain something very, very important over here. Don't write anything. I want everyone's attention only and only on screen. Total earnings, which will be the symbol as E1, we have already figured out that EPS is going to be rupees 50, and at the beginning of the year there were 20,000 shares. So of course total earnings will be 20,000 multiplied by rupees 50 per share, and that will be 10 lakhs, whether it is case 1 or case 2. Next thing, from total earnings, if I subtract dividend, so please understand what I am doing. I am mentioning the variables within the brackets. E1 in the formula indicates expected total earnings, whereas D1 indicates dividend per share. So N into D1 will give you total amount of dividend. So in case 1 dividend is 0, in case 2 dividend payout is 100%, so N into D1, that is representing the total amount of dividend, it will be 0 in case 1 and 10 lakhs in case 2. From total earnings, if I subtract total dividend, what I will get is retained earnings, which by formula would become E1 minus N into D1, and that would be 10 lakhs and 0. So if you are clear with this much, let me now mention the next variable I1, that is investment obligation. This company has investment obligation of 20 lakhs. Now what is the meaning of investment obligation? If I try to explain to you, see, by end of the year company has some projects lined up and it is committing itself to invest certain amount in those projects. So the investment that company has to make by end of the year, that is mentioned as I1, which is 20 lakhs in our example. So I have explained you what is the meaning of this investment obligation. Now use your brains, beta, use your brains. In case 1, for 20 lakhs of investment obligation, we already have 10 lakhs of retained earnings available because we have earned profit and not distributed that profit by way of dividend, so that money is lying with the company. So case 1 indicates that 10 lakhs of retained earnings is lying with the company, which is available for investment. So now in case 1, out of 20 lakhs requirement towards investment, we already have 10 lakhs available in the form of retained earnings. If we subtract that, we will get the remaining amount that is falling short in our investment. What I am trying to tell you, let me explain in detail once again. In case 1, we are having a commitment towards an investment plan where we have to invest 20 lakh. Rupees 20 lakh is the committed amount to invest. In case 1 itself, we are having 10 lakhs of retained earnings. Now what is the meaning of retained earnings? The company has earned profit but has not distributed it by way of dividend. Company is still holding that money. So that money is anyway lying with the company. If company has to make investment of 20 lakhs, it is already having 10 lakhs. So what is the shortfall? The shortfall amount will be 20 lakhs minus 10 lakhs. Only 10 lakhs is the shortfall. However, in the second case over there, all the profits have been distributed by the company by way of dividend. So nothing is left over in hand. So whatever be the investment obligation, 20 lakhs, that whole amount is falling short. We don't have a single penny in hand, and we will have to arrange entire 20 lakhs from some source. So I'm sure you understand that from the investment obligation, if I subtract the available retained earnings, I will get an amount of shortfall which must be arranged by issue of new equity shares. Now how to take it ahead, please try to again carefully understand. So amount to be financed by issue of fresh equity shares at year end at P1 price. In case 1, what we need to arrange is only 10 lakhs. In case 2, it will be 20 lakhs. Now case 1 and case 2, we will be issuing new shares for this amount of shortfall, and the issue price P1 will be different in case 1 and case 2, and fortunately we have already found that price in the previous working as 250 and 200. Now whatever is the shortfall, if you divide it by the share price, for example in case 1 the shortfall is 10 lakhs, so we would want to arrange 10 lakhs. When you issue one equity share in case 1, you will be getting an inflow of 250. So how many shares you should issue? I repeat, how many shares you should issue to get 10 lakhs of shortfall covered up? So the answer is simple, 10 lakhs divided by 250. However, the shortfall in case 2 over there is 20 lakhs, and to arrange that 20 lakhs, when now in case 2 you are issuing shares, the issue price P1 will be only 200. So the number of shares that you should issue will be 20 lakhs divided by 200, and once you get the number of shares to be issued in each of these two cases, then we shall move ahead. So I'll show you what will be the number of shares to be issued in each case, and we are calling this as small m. If you can recall from the model formula, small m indicates additional shares issued at year end. So it is 4,000 shares in case 1 and 10,000 shares in case 2. Please pay attention on the screen once again so that I explain you all the variables over here. Please look into this first variable E1 and try to now keep it in your mind that E1 as per model formula, it is indicator of total earnings. D1 on the other side is dividend per share. So N into D1 will indicate total dividend. So E1 is total earnings and N into D1 is total dividend. So E1 minus N into D1, something what we have computed over here, will indicate retained earnings. Thereafter, from I1 we have subtracted retained earnings. So basically from I1 we have subtracted E1 minus N into D1. When you subtract that from I1, you get this shortfall, right? You get this shortfall, and that shortfall, when you divide by P1, which is the share price at year end, you will be getting the number of shares to be issued by year end, which is the variable M. If you have understood this much, let me now take you ahead and show you one thing, that retained earnings was written as E1 minus N into D1. Investment obligation is I1. So shortfall which is yet to be financed by end of the year will be I1 minus, within brackets, E1 minus N into D1. And number of shares to be issued will be the amount of shortfall divided by P1, correct? So we get the value of M. So we now write up a new intermediary formula, that is the formula for M, that is number of shares to be issued, and that intermediary formula is going to be very, very important for all our calculations ahead. M equals to I1 minus E1 plus N into D1 divided by P1. If you are wondering that from where did we get this plus sign, observe this formula over here. Within brackets it is E1 minus N into D1, and outside the bracket it is minus sign. So when the brackets are opened, minus sign applied to E1 makes it minus E1, and minus of minus N into D1 will actually give you plus N into D1. Now if I cross multiply, what happens? P1 will be multiplied to this M, and what we will get is M into P1 equals to I1 minus E1 plus N into D1. And from this value, or from this equation, we can get the value of N into D1. If I want to find value of N into D1, both of these factors, I1 and minus E1, I'll shift to this side. So what do I get as N into D1? I get the value of that as M into P1 plus E1 minus I1. Now let us move ahead and understand the last chain of this formula derivation, something very, very important. You would be surprised to know that even model formula is derived from this core formula. P0 equals to D1 plus P1 upon 1 plus KE. In this equation, if I multiply N, the variable N, to both the sides, N stands for number of shares at the beginning of the year. Do you know what will I get? N into P0 equals to N into D1 plus N into P1 upon 1 plus KE. And some time back we have seen that N into D1 is M into P1 plus E1 minus I1. We will now substitute this value of N into D1 in the above formula of N into P0. So we rewrite the formula of N into P0, and what we now do is, in place of N into D1, we write this value, that is M into P1 plus E1 minus I1, and let us see what we get. M into P1 plus E1 minus I1 plus N into P1 divided by 1 plus KE. And now can you notice this term N into P1 and this term M into P1, they both have P1 as common. So M into P1 plus N into P1 I can rewrite as M plus N within brackets into P1, like this. M plus N into P1 plus E1 minus I1 upon 1 plus KE will give you the value of N into P0, and this is how the formula by model is derived. Let me take you ahead and write up this formula to prove one thing, that whether it is case 1 or case 2, we are not going to have any difference in the formula. Now notice one thing, that here I am defining all the variables, but you have already defined each of these variables in the solution. Once you have already defined, you need not write it again and again. I am showing it over here just for your understanding, that these all variables we have already defined, and the formula also we have written, so there is no need to write this. In fact, when you write the formula now, you would apply case 1 and case 2 to prove that your calculation will be same with respect to NP0 whether your dividend is declared or not. In other words, irrespective of the dividend payout ratio, the NP0 value will remain same. So this is one very important thing in model, that your share value does not change with your dividend policy. You give less dividend, you give more dividend, you don't give dividend, you give dividend, NP0 will not change. That is what we consider as outcome of MM's model. We have seen in Walter's model and Gordon's model that value of share, that is P0, is dependent upon your expected dividends. The reduction or increase in the amount of dividend or in your dividend payout ratio can change value of the share, but in MM's model, value of share will never change irrespective of your dividend policy. And to prove amount matching with 40 lakhs, you can simply write NP0 equals to 20,000 shares, that was N, and P0 as 200. So 20,000 into 200 gives you 40 lakhs, and the NP0 written above was derived out of the formula. What I am trying to tell you is this NP0 is computed as 40 lakhs from the right hand side of the equation, and this NP0 40 lakhs is computed from the left hand side of equation, and hence it is proven that NP0 will be 40 lakhs whether you take left hand side for your calculation base or the right hand side. Now let me take you ahead and show the same calculation with respect to case 2. So same formula, don't have to write that formula again and again. I am showing that on screen just for your reference. So in case 2, whatever be the change in the values, just put it across in place of these variables, and let us see what is the value of N into P0 that you now get over here. It is still 40 lakhs. So proven one thing, that whether it is case 1 or case 2, NP0 will remain 40 lakhs.
नवंबर 23 में सक्सेस के लिए हम ला रहे हैं सी फाइनल एसएफएम के मोस्ट इंपॉर्टेंट क्वेश्चंस की लिस्ट, दैट टू विद कंप्लीट सॉल्यूशन. लास्ट में 23 पेपर टफ था, स्टिल 72
Okay, so I think it was clear. The video was self-explanatory.
Yes, sir.
Okay. So for today, I am ending the class. If you have any doubt, you can ask me in the next class. Okay. I hope everyone has given you attendance in the chat box.
Yes, ma'am, I have. Yeah.
Okay. So thank you.
Thank you, ma'am. Good weekend.
Thank
Bye.
you. Bye. Bye.
All right, thank you. Bye.
क्या करता है? वहाँ बैठते ना, हमको चेक से लगा लिया कर. Bye.